Dear all, MeDirect thanks you for joining this webinar, the sixth in our MeDirect Talk series, where we aim to introduce you to financial experts and asset managers so that they can share their views on the financial markets and investment opportunities. This webinar is aimed at providing you an insight on sustainable investments. MeDirect has always been at the forefront of providing you with the latest on the investment world, and we aim to continue doing so through our regular updates on our website and social media. Our team of experienced wealth advisors are always available to assist you. In the last few years, sustainability and sustainable investments have become buzzwords. We keep hearing about ESG investments, those investments that take into account environmental, social, and governance factors. But are these just buzzwords, or are they better investments for us? Today, together with Mike from the Liontrust Sustainable Future team, we will be having a look at the aims and approaches of sustainable investments together with the demand and performance of this sector. Following the presentation, we will have a Q&A session that will be moderated by James. Throughout the session, please feel free to send us any additional questions you might have through the Q&A function. James, over to you to introduce yourself and Mike.
Well, good evening, ladies and gentlemen, and I would like to say it's a real pleasure to be speaking to you over the internet, which is something we're all quite used to doing these days, unfortunately. Mike Appleby, who is going to be making the major part of this presentation, and myself would dearly love to be with you in Malta doing it directly this evening. But that's not possible, and we're all hoping that will be possible at some point soon. This is the second time that our partners, MeDirect, have invited us to join a MeDirect talk. We're very pleased and proud to participate in these events. The last time, some of you may remember, was at the Palace Hotel in Salema, and of course that would normally be followed by a nice drink. So I would ask you all to raise a glass in the name of sustainable investments once we finish this evening. The main show this evening is Mike Appleby. Mike is a long-standing member of our sustainable investment team, a team that on Friday last week celebrated their 20th birthday. And for those of you who are less familiar with sustainable investing, to have a fund management team that has been doing this for 20 years is really something of an achievement. It's quite a recent phenomena for a lot of fund management businesses, but not for our sustainable investment team. Mike has been in the team for 17 years. He's an investment manager that is focused on certain thematic investments, but he's incredibly well-versed in the world of sustainable investing. And as Ingrid just said, it's a little bit of a difficult world to navigate. So the aim of the presentation this evening is not to show you how wonderful Liontrust is at doing this, although there will be 2 short slides at the end on that, which I will speak to. But it's more to sort of take you on a trip through what sustainable investment is and what it represents in the world today, and how it is, we believe, a better choice for investors in the future in terms of building a better world for ourselves and for the future generations. So before I hand over to Mike, Mike is part of a team of 13 people dedicated purely to fully integrated sustainable investment at Liontrust. And our fund management company has grown to £30 billion now. And a lot of that recent growth is really thanks to Mike and his fellow colleagues in the sustainable investment team. They are now managing 1/3 of the assets of Liontrust Asset Management, so more than £10 billion in our sustainable investment strategies. I'm going to stop there. I'll pick it up at the end with a couple of slides, and we're really hoping you're going to join in and weigh in with your questions, which we will take one at a time at the end. I shall hand over to Mike, who will take you through our interesting presentation.
Thank you very much, James, and thank you all for joining us, and good evening. So the purpose of this presentation is to help you understand sustainable investment. And I want to take you through what exactly it is, the different approaches that fund managers can use that make it different to a conventional fund. And I want to look at the extra analysis that goes into looking at these sustainability aspects and show how that can improve the investment decisions. And I'll be looking at some examples of themes, sustainability trends, which are a big part of this. And finally, I'll talk a little bit about the additional disclosure that you will see outside of sustainable funds, showing the sustainability attributes of those. So let's start with, what is sustainable investment trying to achieve? So the first thing is, it's trying to deliver competitive investment returns by investing in sustainable companies. Now, I'm going to spend a bit of time explaining what we mean by sustainable companies later, but that's the first objective. And the second objective is to use their influence as investors to get companies to improve the way they manage their business. And this is particularly in the aspect of how they interact with the environment and society. So those are the aims of sustainable investment. And it's super confusing now because there are so many three-letter acronyms flying around about this and so much jargon. So what I'm going to do is just take you through the three broad approaches that can be used in sustainable investment and help you understand that. So the first one's pretty straightforward. This is often referred to as ethical, but it's about avoiding controversial industries. And the vast majority of investors are satisfied by the exclusion of weapons and arms, tobacco, gambling, and pornography. And there are also other things which get excluded, like companies exploring for fossil fuels, etc. This is quite a simple approach. It's been around for a very long time. The Pax Fund started off in the 70s. That was all about avoiding companies making money out of Vietnam, etc. And this is something which I think everyone's probably fairly familiar with. So you can think of this approach as being defined by what they don't want to get exposure and invest in. So that's the first approach, pretty straightforward. The second approach, I'm calling this sustainability themes. This is about finding companies that are helping us to develop in a more sustainable way. And these companies are typically going to experience long-term structural demand for their products. And if they're profitable, these could make really, really interesting investments. And I will be talking a lot more about this later on. I think this is a really fascinating area, and a lot of people are really interested in this as an investment proposition. If I can make money, good investment returns, by investing in companies that are helping us to develop in a more sustainable way, then I think that's something that appeals to a lot of people. So in this approach, it's really defined by what they are trying to get exposure to. And an extension of this that we've seen more recently is this idea of impact investing, where you're actually trying to quantify some of the positive impacts that these sustainability themes are having on our shared economy. I'll talk a bit more about that later on too. The final approach is engagement, and this is where you meet with companies and encourage them to manage their business in a proactive way and get on top of the relevant material issues that are facing that particular industry. And what's different here from conventional funds is, yes, you will be engaging with companies on normal governance stuff like the independence of the board, alignment with pay, making sure that investors and senior management are aligned, etc. But this also includes things like operational performance, particularly in terms of the environment or safety. And it can also, in some businesses, look at things like labor conditions within their supply chain. So these are the three approaches that fund managers can use to make their investment decisions different from what you would have in a normal conventional fund. Now, in practice, what happens is most funds are a hybrid of all three of these approaches, and they will avoid certain controversial industries. They will be trying to gain exposure to these positive sustainability themes, and they will also have an active engagement strategy going on as well. And I hope to show you through this presentation that through this extra analysis, it can actually help you find out more about businesses and help improve your investment decisions, certainly over the medium term. So there's been a huge amount of raised awareness, and I think this probably started with the Blue Planet and Sir David Attenborough realizing how much plastic that we discard eventually ends up in the sea, and what awful impact that is having on the things that live there. I think there's been a general awareness that it's been helped by the climate activists like Extinction Rebellion and Greta Thunberg, and people are really realizing that we're having a major impact on the environment and indeed on society as well. And they want to do something about it. And they're changing the way in which they consume. And they're realizing that also this can influence how you invest. And there are a couple of pictures down at the bottom here. On the far left, this was a heat wave that happened a couple of years ago. This picture was taken in Paris. These are people standing in front of mist machines to try and cool down so they don't conk out. The whole country was brought to a virtual halt, many parts of it, for a number of days as a result of this extreme weather event. This in the middle at the bottom is a bridge in northern Britain, and that's a 300-year-old bridge that got washed away as a result of extreme flooding in the summer. And there are multiple examples you can think of, wildfires, etc., that are making people aware that we are having a negative impact around us. But it's not just about the environment. This slide on the bottom right here shows that this is just in the UK, but I think this is still something that happens in many other places as well. Every sector still pays men on average more than women. And these are things that people are thinking, hold on a minute. Surely we can do things smarter than how we're doing them now and take these things into account. And this awareness has translated into a lot more people wanting to understand more about sustainable investment, a bit like all of you lovely people on this call. And looking at polls and general market research that I've seen pretty consistently over the last 3 to 4 years, I'm seeing that about 70% of people, private investors, want to find out more about sustainable investment. So this is something that the majority of people want to know more about. It is no longer something that just a very small select people that are very principled are interested in. And so we have seen growing demand for this, and we expect that to continue in the decades to come. Let's now talk a little bit about investment returns. There is growing empirical evidence to show, for example, that companies that are ranked better in terms of how they manage the relevant environmental, social, and governance aspects in their industry, those that are ranked better in how they do that, deliver better investment returns than companies that are ranked poorly on those ESG rankings. ESG stands for environmental, social, and governance. And this is a paper by Frieda et al., which looked at over 2,000 peer-reviewed papers in journals. And it showed that while some of them showed a negative relationship between better ESG management and resulting investment performance, the vast majority of them showed a very positive relationship with companies that are ranked better in terms of their ESG management, delivering much stronger investment returns. And indeed, if you look around, I'm not saying that any fund that's got sustainable in the title is going to do really, really well, but there are a lot of sustainable investment style funds that have been around for a long time that have generated very good risk adjusted returns that are competitive versus their mainstream peers. And there are many different types of funds that are available. There are equity funds and bond funds and multi-asset funds as well. So it can deliver very competitive investment returns. So how does this work? Because people are like, how can we possibly make decent investment returns when we've got one arm tied behind our back and we can't invest in all the grubby stuff that makes loads of money? Well, the quick answer to that is that sustainable investment fund managers do extra analysis that helps them make better investment decisions, and that improves their investment performance. And that extra analysis falls into two main areas. The first one is how well companies are managing their environmental, social, and governance aspects. This is no surprise compared to, if you think of that previous slide, showing that positive relationship between this and investment returns. And indeed, a lot of people think if you look at an industry, all the companies are the same. They're not. If you do the analysis and look at it, you find there is a great disparity within industries. And there are some companies that are very proactive in how they manage this interaction. And they are using it as a competitive advantage to gain share over their peers, as well as retaining staff. And you also see other companies in that same industry that are very reactive. They don't like to talk about this. They maybe feel that it's not very material to their business, and they're really hoping that we just go away and that the world doesn't change. So that's one area that an extra analysis happens. And we think that by doing this analysis, it's a very good proxy for the quality of the management team. Generally speaking, really good management teams that deliver on their strategies are generally quite good at this aspect of their business, because it's material to their future success. The second area, which I want to spend a little bit more time on now, is looking at longer term trends. And because we believe that companies that are the right side of these long-term positive trends make much more interesting investments than companies that are fighting against them. Now, let's think about some long-term trends, because we don't read about these very much. It's not something that gets captured in the news, but there have been some really positive trends that have been happening in our economy that I just want to highlight to you. For example, if we look at child mortality, this is a very sad statistic. These are children that don't make it to their 5th birthday. If we look over the last 150 years or so, we've seen this number globally go down from an eye-watering nearly 20% of kids not making it to their 5th birthday, until now it's just a fraction of a percent. Also, if we look at the air quality in many developed cities, we can see that, for example, in the UK, particulate matter, PM2.5, these are tiny little bits of dust that you can't see, that are very bad for you. They're very bad for children's health as well, and for development. The incidence of elevated levels of this in cities has fallen by 90% in the last 30 years or so. A massive decrease in the that particulate matter in those cities. And also another area, again, more in developed markets, but we've seen huge reduction in road fatalities, and the number of people dying on the roads has more than halved over the last 30 years or so. So these trends are going on all the time. And some observations about those trends is that one, they're quite long term, and they're not necessarily over. I'm not saying that air quality is brilliant. I'm just saying it has been improved. But the other thing is that a lot of these trends have been driven by companies that are providing innovative products and services that are helping deliver those positive outcomes. And we can think of vaccines and as well as sanitation products and things that have really helped improve those child mortality rates. We can think of bits of kit in cars that have made things safer, like seat belts, etc. And now we're seeing active emergency braking and all kinds of things that basically make it harder to have a crash in a car. And indeed, lots of bits of kit that have been put onto vehicles has helped reduce those particulate matter pollution within cities. So I'm putting it to you that this extra analysis, rather than it being a hindrance, it's actually really useful because we learn things that can help us understand the companies and have a much better idea of how they're going to perform over the next 5 to 10 years than if we didn't look at this at all. Now, those two examples I gave you are pretty slow, 3 examples of slow positive change that happened. Apologies, this hasn't come out particularly well, but if we could look at the picture on the left-hand side of your screen, this is taken in 1900 at the Easter parades in New York City. And you'll have to take my word for it, but every vehicle there is a horse-drawn cart. There is one exception, which is a motor vehicle, which is circled in red. If we move to the right-hand picture, we can see this is New York 13 years later. And every vehicle there is an automobile or a car as we know it now. And there's only one horse-drawn cart, which is circled in red. Now, what happened here was there was a big environmental problem in cities, and that was horse manure. And it was something that people were struggling with. Along came a product that was much better than the previous product. It didn't deposit manure everywhere, and it was faster. And I think the thing to take home from this is this transition happened in 13 years, 3 years. And you do get massive, really fast disruption when you have a new product that comes along that's much better than the last one. We're beginning to see that in some areas in our economy now. So it's important to understand which way these things are going so that you can think ahead and be planned and not be invested in the companies and the businesses that are quietly going extinct because the products and services they provide are not as good as alternatives that are coming out. So let's think about these sustainability trends. I mean, it's very easy to think of when people think of green funds, they think of renewable energy. And listen, renewable energy is really important. We're going to talk about that in a bit more detail later on. But there are lots of different sustainability trends. And I put them into 3 buckets. The first one is about resource efficiency. This is about the way we use water, the way we use energy. It's about increasing renewables onto the grid. It's about increasing the amount of recycling that we use for our finite resources. So that's resource efficiency, the kind of thing, environmental technology that everyone's very familiar with. But there's a second group of trends going on as well, and this is to do with our quality of life. This is to do with how well we treat disease and manage disease. It's about innovation in healthcare. It's about improving our lifestyles because non-communicative diseases are a big driver of disease. And one of the big drivers of that is related to obesity, and it's essentially about an unhealthy lifestyle where you're eating too much high calorific food and not doing enough exercise. And there are companies out there that are reformulating foods to make them more healthy and yet still taste the same. And there are also companies offering much more affordable ways to exercise at these low-cost gyms and things like that. So there's a broad range within that improving quality of life, and I would include education in there as well. And then the last group I would think about is about making us either safer or the systems that we rely on more resilient. So an example there would be safety in travel. So we talked about cars. But also, let's think about cybersecurity. This is a classic example. As more and more of our lives go online, it's important that our information is kept safe. And if you talk to chief technology officers, the one area they're not dialing back their spending on is on cybersecurity, because as one of them said to one of our analysts, you only know if you spent enough on cybersecurity when it's too late. So the point I'd want to make here about these sustainability trends is that there are a very broad number of them that reach right the way across our economy. And by understanding these trends and the companies that are helping to accelerate those trends, you can identify areas of the market that are going to experience structural growth. They're going to grow for a long time. It can also help you avoid areas that are going to experience structural decline as a result of us not wanting or being regulated against using their products and services. And this helps us build diversified portfolios that go right the way across the economy, looking at all these different pockets of structural growth. Okay, I now want to talk about climate change. This is a big deal that affects lots of different parts of our economy. Just a recap for anyone that has missed this. The global average temperature has been rising. This isn't that much of a big deal. It's been going up and down since history began. But what is a big deal is that the rate of change since the Industrial Revolution is faster than it's ever happened before. And the main reason for that is emissions coming from human activity. So if we take the global average temperature as it was in, say, 1880, before the Industrial Revolution, and we compare the global average temperature now, we've already increased the global average temperature by about 1 degree centigrade. Now, that might not sound like a big deal to you, but 1 or 2 degrees centigrade as a global average temperature is typically enough to kick you in or out of an ice age. So these global average temperature change, a small change, is a big deal. And there is international agreement through the Paris Accord to try and limit the global average temperature rise to be ideally 1.5 degrees, in which case we don't have a lot of time left, but if not, less than 2 degrees. And this is by the end of this century. But if we look at all the policies that are out there that governments have made and targets that they have, if we assume they met all of those targets, which is still a big if, we are on track for about a 3.5 degree global average temperature rise. And so the conclusion from this is there will be tightening regulations globally to try and reduce greenhouse gas emissions from human activity. And these are going to have really big investment impacts. And there'll be some companies that win and some industries that win, and there'll be some that will be losers from this. But we can expect over the next 3 decades for this to be a permanent feature. And these regulations are only going one way. Now let's look at the different parts of the economy and how they're going to be affected. Okay, renewable energy is clearly a winner. We all know that it's critical to replace electricity generation from fossil fuels with ultra low carbon wind and solar. And over the last 20 years, the costs of installing wind and solar have plummeted, and now they are the cheapest form of new electricity generation in many parts of the world. And that's really, really good news. But if we were to wake up tomorrow morning and all of the fossil fuel powered electricity generation had been magically replaced with ultra low carbon wind and solar, we would have reduced our greenhouse gas emissions by about 1/4. So the point here is this shift to an ultra low carbon economy is going to happen right the way across our economy, and it's going to affect indeed where we get our electricity from, but also how we heat and cool our buildings. It's going to affect industrial processes. It's going to affect transport modes, and it's also going to affect food, agriculture, and land use as well. So it's not just about renewable energy, although that's critical. So an area we see a lot of really interesting investment opportunities is within energy efficiency, because if you can reduce the amount of energy that is wasted, you reduce the end user's energy bill, you also reduce emissions in the process. And there are some really interesting businesses out there that are able to make really good investment returns by investing in projects that are bringing down the wasted energy, saving people money, and reducing emissions at the same time. And this is happening in a few areas. It's happening in the way we heat and cool buildings with insulation and smart ways of HVAC, heating and cooling, smarter lighting, so light emitting diodes, LEDs, which are just way more efficient than incandescents. And we're also seeing it in emerging markets in super efficient air conditioning. And that's an area where we see lots of really promising investment opportunities to benefit from this need to decarbonize. We think there's going to be huge disruption in transport. Indeed, we're seeing this already. We think the days of the internal combustion engine are numbered in many of the areas it's used today. But there are really interesting opportunities in the bits of kit, essentially, let's just use cars, that go into cars to move them away from an internal combustion engine towards an electric drivetrain or even a hybrid. And one area, for example, is the amount of chips that manage. These are things that look a bit like the SD card that you stick in your camera, but they're there to manage the power flow through the vehicle, the electricity, if you like. If you think of a normal internal combustion engine car, they're about 200 or maybe 300 euros of these chips, energy management chips in a vehicle. If you go to an electric vehicle with active safety, it's probably more like 1,000 euros worth of these chips are in that vehicle to control and manage all the power. And, there are companies like Infineon, which is a German company, which makes super efficient chips that are used in cars. And they are set to benefit from a long period of structural growth as more and more of their products get included in cars over time. Lots of other examples as well. And I guess it's worth pointing out that there are incumbent carbon-intensive businesses where there are lower carbon alternatives. Many of them are really going to struggle, and certainly not all of them are going to survive. So that's an example of a theme, a big theme, the climate crisis and our need to shift to an ultra-low carbon economy, and how that's going to affect lots of different parts of the economy, and therefore is going to affect investment returns as well for those of us that are invested in it. So I've talked a little bit about trends, sustainability trends, and the quality of management looking at ESG, but how do you actually include all this stuff into the investment process? because this has got to influence your investment decision. It can't just be something that you look at and you do a little tick box and then you ignore it. So we believe that for any investment to stand a good chance of outperforming over the medium term, there are 4 aspects that need to be right. The first one is that sustainability trend. We've talked about this. We want to be the right side of a long-term sustainability trend, helping to accelerate that trend as opposed to fighting against it. The second thing is we want a management team that are managing their business in a holistic way and understand the competitive advantages to be gained from taking a proactive approach to this and being one of the more sustainable businesses providing the more sustainable products and services within your industry. So those are the 2 sustainability aspects, if you like, but those on their own are quite unlikely to outperform. So the other 2 aspects are more traditional ones and conventional ones that you'd look at. I've called this business fundamentals. This is really looking at how profitable the business is, what kind of investment returns are they making from deploying capital within their business, and are they doing something that's difficult to replicate, and is it likely that they're going to be able to maintain that margin for a period of time? So we want companies with good business fundamentals that are profitable. And then finally, valuation. We want to feel that this company could be worth significantly more, say on a 5-year time investment horizon, without having to make really heroic assumptions about that. Because it is possible to find companies that are the right side of the trend, have got really proactive management, they're making good investment returns, but look really, really expensive, even looking out 5 years' time. So it's when all 4 of these aspects I've got up on the screen now, when they are positively aligned, that is what we would define as a sustainable investment in a sustainable company. So it's important that the investment process, includes these in every investment decision. I'm now going to look at one more example of a trend, and this is going to be more about a specific company before talking a little bit about disclosures and stuff. So let's think about how much money we spend on healthcare. And this is pre-COVID-19. So there is a long-term trend underlying COVID-19 that is expected to happen over the next decades and beyond. The amount we spend on healthcare is incredibly high. I don't have the number in Malta, but in the UK, it's about 10% of gross domestic product. But I want to focus in this example in the US, where they spend an eye-watering 17% of GDP on healthcare. And this amount of healthcare expenditure is expected to continue to rise. And also, it's worth noting that the big pharmaceutical companies, the amount of new drugs to treat disease that they're finding for every, say, euro of investment in R&D is falling. So if we put these together, there's a bit of a problem. So what we're looking for to solve this problem is we're looking for innovation. We're looking for companies that can come up with smarter ways of doing what we're doing now that enable us to give better patient outcomes, but also in a much smarter and cost-effective way. Let's think about drug trials. So as we all know, before you're able to use a new drug on the population, you need to go through drug trials. And you start off, there are 3 phases to those drug trials, and the number of people in those drug trials get more and more as you go through. And to begin with, you want to find out whether it works. And then gradually you want to increase the number of people in the trial to make sure it works for all sorts of people, for people at different age groups, for people with different existing medical conditions, etc. So you can make an assessment as to, does this drug work, and what are the potential negative side effects, and who will those affect? Now, the cost of a drug trial is typically between $2 million and $400 million. This is in the US. That's not a massive number compared to the amount of money spent in developing drugs, but 50% of drug trials take longer and cost more than they originally planned. And 80% of the time, the reason why that happens is that the recruitment, identifying the different types of populations with the different pre-existing medical conditions, isn't designed properly, and you have to redo bits of the trial. And that means that the trial takes longer. And it means it takes longer for you to be able to deliver this new drug treatment to people. I don't need to tell you how important this is, particularly in what's going on with COVID-19. So this brings me to a company called IQVIA. This is a US listed company. It's around about $45 billion in market cap. And they're quite unique. They have data on every prescription in the US. And that gives them a lot of information, and they are able to use that information to help design and plan drug trials. Because if you are trying to get a sample population to trial this drug out on, this can tell you, it obviously tells you how old the people are, but exactly what existing conditions they've got. And they very cleverly developed a system to help design drug trials really, really well. They even run drug trials. So they have their own centers in the US, and they can do the whole gamut of running the drug trials, as well as designing and monitoring them for you. And they're really good at it. This is what they specialize in. So, for example, in a breast cancer drug not long ago, they were able to get that, because they had designed and were very good at doing these drug trials. They got it done 3 months earlier than on average before. And 3 months is a big deal in getting good patient outcomes early to people with drugs or treatments that are better than the existing one on the market. So let's think about this business in terms of those 4 aspects that I mentioned earlier on. So it's exposure to the theme. So the whole business is about, is to do with drug trials. It's not just a tiny little bit of the business on the side. And because they're so good at it, demand for their services is growing at around about 7% a year. This is pre-COVID, by the way. Incidentally, they are involved in 4 different trials that are going on at the moment that are related to COVID-19 vaccines, incidentally, in the US. And the reason why there's demand for it is the pharmaceutical industry has generally realized that these people are the best people to get this done. In terms of the management team, they're very good. They're on top of it. We believe that they are managing that business really well. If we look at the business fundamentals, the returns on invested capital are around 25%, which are significant. And also, it's very hard to copy what they're doing. They've got a very good competitive advantage. And if you pull this all together and look out, on a 5-year view, we believe that this stock is significantly undervalued. But I would like to stress, this is just an example of how sustainable investment, when it's done properly, that's how they will be thinking about it. I'm not suggesting for a moment that you all run out and buy IQVIA. This isn't a stock recommendation. It's just an example of how sustainable investors will think, and how by pulling in all these 4 aspects, you can make a much better investment decision than by simply ignoring everything on the left-hand side of the slide. Okay, so another thing that sets sustainable investment funds aside from conventional funds is you'll see additional reporting on the sustainability aspects. So the first one is disclosing what proportion of the fund is invested in companies that are exposed to these different positive investment themes that are there. This, for example, is our Liontrust Sustainable Future Global Growth Fund, and you can see that about a third of it is in the resource efficiency bucket, about a third of it is in that improving health and quality of life, and about a third of it is in safety and resilience, giving us a really diversified portfolio that's exposed to all of these different positive investment trends on the right-hand side. So if you're not familiar with them, the United Nations Sustainable Development Goals, or they're called SDGs, these are internationally agreed goals to try and meet by 2030. They replace the Millennium Goals. And this is a vocabulary that people are beginning to use more. And indeed, it's quite useful to a way to express things that relate to sustainability, which some people find quite difficult to talk about. So, for example, you would have companies that are involved in healthcare parts exposed to SDG 3, good health and well-being, and you will see, funds disclosing a map of where their investment theme overlaps with one of these goals here, and that's something you should be aware of. And I suspect you will have seen these in not only in fund reports, but also in annual report and accounts and sustainability reports, etc. So this is something to be aware of. It's quite a useful vocabulary. I would say not all of these are entirely relevant to investment. This is really more done at the sort of country policy level, but it's still a useful way to think about this, and something that's getting used more and more. I wanted you to be aware of that. Another area where you'll see additional disclosure, because it's so critical, is to do with carbon. So, for example, we're looking at three aspects here of a fund, and this shows that the companies in this fund emit 90% less carbon dioxide from their operations compared to that market as a whole. 35% of the portfolio is invested in companies with technologies which directly cut carbon emissions, and there is no investment in companies that are involved in the extraction or production of any fossil fuels, coal, oil, or natural gas. Now, if you think about that slide when I was talking about climate change, the idea that there will be tightening regulation globally, let's just imagine that we woke up tomorrow and there was a cost on each ton of carbon that got emitted from an industry. Some areas have this of the world, some don't. And let's just say that was 50 euros a ton. What these companies would do is they would try and pass that on to their customers. If their customers could accept that cost, these businesses' margins would be exactly the same. If the customers don't accept the cost, the company will have to bear some of those costs, and their margins will get smaller. They'll become less profitable. And the point I'm trying to make here is this portfolio is very resilient to future changes in tightening global regulation to bring down greenhouse gases, because they've got 90% less carbon cost to pass on to their customers, and therefore their margins will be more resilient than the market as a whole, which has far more carbon. So it's invested in lower carbon intensive companies. So let's just recap on what you get in a sustainable investment style. So it's invested in companies that are doing positive things, essentially making our economy cleaner, healthier, or safer. The fund manager is engaging with those businesses to improve how they're managed, and maybe we can take some questions on that if you want more detail at that later. It's avoiding controversial industries, and it is all about delivering competitive investment returns while that is going on. They are can be consistent. That's I'll quickly run through the learning outcomes. Of course, the different approaches. Remember, avoidance, that's ethical, of controversial industries. Those positive sustainability themes, getting exposure to those companies that are going to grow a lot because they're providing stuff that we need, and as well as that engagement. And we can see that this idea of providing positive outcomes for our economy can be very consistent with being profitable, generating good investment returns, and matching investors' values. And we've looked at how those themes and understanding those sustainability trends can help us find areas of structural growth in the market that are potentially interesting to invest in, but only if they're profitable, well managed, and we see upside. And we've seen some examples of companies that are helping to drive those positive trends. That's where I come to an end. I would like to hand over to James now, who's just going to wrap up before we go into a little bit of Q&A. So thank you, everyone. I'll hand over to James.
Thank you, Mike. I'll just remind you that you're still in charge of moving forward the slides, if you don't mind.
Yes, I am. Would you like me to move on to the next slide?
Please do, please do. So thank you very much for that stimulating and broad overview of the world of sustainable investment. But of course, what does it actually mean? You know, how can you access this world of sustainable investment at Liontrust? I mean, working with our partners, MeDirect, we have several funds which are available to you as investors. And they are two flagship strategies that both have track records going back to 2001. The first of those funds is a global equity fund. And I would really like to point out the way we manage money here. It's a high conviction, focused portfolio of equities. So between 40 and 60 equities. Today in this particular fund, we hold 50 equities. So we're showing our conviction. And it is spread across all the themes that Mike has alluded to during his presentation. So we have diversification across themes, across regions, across industrial sectors. But the one thing that ties all of these portfolio holdings together is, of course, the fact that they are leading sustainability companies, and that our team has undertaken extensive qualitative research to get to the point where we feel that we can invest within these companies. This portfolio that is available is a Dublin domicile fund, which we actually launched in November 2019. So for various regulatory reasons, I cannot show you the 20-year track record, but I can guarantee you that it is a continuation of what you're seeing here. So this is a fairly short time period of 15 months, but you can see that the portfolio has delivered significantly better returns than just the broad global equity market, the MSCI World. And I would always like to say, we always compare ourselves to broad equity markets. You will find, if you look out there, that there are ESG indices which you can follow. We are interested about delivering superior returns through sustainable investment, but superior to the broader market. If you could just move on to the next slide, Mike. So that was a global fund. We also have a more regional product, which we're working with MeDirect on, which is a pan-European fund. It has exactly the same characteristics as I just described for the global fund, 40 to 60 names, high conviction, not evenly, but diversified across themes and sectors and countries. Here we've got a much longer term view, because the Dublin fund actually does have a track record going back 20 years. So we're looking at this slightly differently in terms of cumulative returns. But this fund is first quartile across any time period you could choose to look at, and again, judged against the MSCI Europe, which is a broad index. So before we move on to your questions, just wanted to frame these two slides. You can, of course, find European and global equity funds that perform better than this. But we believe you'd be hard pushed to find integrated, sustainable investment funds that offer you this type of diversified exposure today and in the future. Because I think what is key in what Mike has told us this evening is that you may consider this to be some kind of investment trend. We clearly do not. We believe this is the future of investing for probably most investors globally. And we have a bunch of questions which we're about to come to, which might challenge that assumption, referring to fossil fuels, etc. So I think we're now going to move on to the questions, which I'm going to host with Mike. Mike, just so that everybody knows, has not seen any of these questions. They're coming solely to me. So hopefully we can catch him out with one or two of them. That will be highly amusing. And
that sounds great. Just give me 90 seconds, James. I've got to go through some important stuff to do with disclaimers. So remember, everyone, just because we've mentioned some stuff, please don't go out and buy it. It's not an investment recommendation. Funds can go up and down. Please speak to your independent financial advisor about anything that you've seen here. These are not investment recommendations. There we go. Those bits are done now. I'll hand back to James, and I look forward to your questions, whether you catch me out or not.
No, I don't think so, Mike. So I think we will try and take them more or less in the order that they came in. There's a couple of questions about fossil fuels. So we have a couple of people who are stating that they're fairly heavily invested in companies like Shell, like BP, and have been so for a while. And that these companies now maintain that they are going green, that they are moving towards renewables. And the question is, do we consider these types of companies to be sustainable investments?
Yeah. Okay, thanks for that. So we don't invest in any companies that are extracting fossil fuels. That includes oil, coal, and natural gas, because essentially over the next 30 years, we need to wean ourselves off fossil fuels. And we believe that those businesses that demand will peak for those fossil fuels and decline. It's very encouraging that the likes of Shell, for example, are pivoting and investing significant amounts in renewable energy. The only thing I would say about that is there are companies that have been doing this for a lot longer than Shell and are much better at finding projects and developing renewable energy. And also the other thing that those companies have, which Shell, that they don't have, that Shell does, is they don't have a huge bit of their business which is necessarily going to shrink over time. So if you're invested in BP and Shell and that's something that suits you, that's fine. We personally, in our funds, think that there are more interesting investments that are going to experience better structural growth than those two, or any of the oil and gas sector.
Thanks, Mike. That leads us into another question, actually, I think quite nicely, which we've received, which is a gentleman out there saying that that he believes in ethical investing and especially clean energy stocks, which is a good start. I would add, but there's been a pretty huge ramp up in the prices of some of these stocks. So could you just talk about valuations? The question is, would we invest in something that is ethical but at the wrong price? I think you may have already covered that, but let's reiterate our point of view. And do we see any of this stuff as actually sitting in a bubble?
Yeah. Okay. So if you go back to those four globes that I looked at, being the right side of the trend, good ESG management, profitable with good business fundamentals, and valuation. If any of those are no good, we won't invest in the company. So there are plenty of companies that we have held in the past that we don't hold now because we don't believe that the valuation is there. We think that that we can find better investments elsewhere. So it's not the case that we're going to invest in this company because it's a really nice, cuddly company doing lots of nice things. If we don't believe it's well managed and that it's going to be profitable and that it's going to beat the benchmark, we would wait and invest in that in another time. So I think that's important. You know, this isn't just about buying nice, fluffy green companies and hoping they outperform. A decent investment process will make sure that you are not invested in anything that's overvalued. And I'd just like to say that everyone's getting very excited about ESG or sustainable stocks getting overvalued. You know, any stock can get overvalued. It's not just something that you know, ESG happens to ESG stocks. You know, non ESG stocks can get overvalued as well. And as any decent investment process, you should be able to make sure that you are not holding something that's not going to deliver a competitive investment return.
Okay, Mike, we've got a number of questions about the sort of future of energy. A couple of interesting ones here, actually. The future of battery technology would appear to be pretty critical in the energy sector, and there seems to be a number of solutions that are being researched. So, how do we invest in that, first of all, and how would we go about choosing the winners in that space?
Yeah, so we see a big trend towards batteries, and there are lots of different ways you can play this along the value chain. We don't particularly like investing in the miners of things like lithium. We think that what's much more interesting is in the area of providing the specialist materials that go into the battery, but critically in recycling batteries to bring down the carbon intensity of those and make electric vehicles much more or much less carbon intensive than they are today. And so, for example, there are companies like Umicore. This is a Belgian company that has a lot of expertise in recycling, particularly platinum, the world's biggest recycler of platinum. And they do make the specialist materials that go into these car batteries. And they are very well positioned to be able to provide high content, high recycled content EV batteries in the future that we think will give them a competitive advantage, particularly in Europe, where we think there will be regulations eventually to make sure that electric vehicle batteries have that high recycled content to reduce some of the impacts, the negative impacts that happen on that. That's a quick answer. I could keep you here all night talking about the energy transition, but I'll stop and leave room for another question.
Just briefly, whilst we're on the same topic, there's somebody asking a question about hydrogen as a solution.
Yeah, so hydrogen's interesting. It pops up every now and again. I mean, we looked at hydrogen a lot about when I started about 15 years ago. I think there are some interesting uses for hydrogen. I think it's very important, though, to realize that hydrogen in itself is not going to solve anything. It all depends how you make the hydrogen. Now, unless you are making that hydrogen by using very low carbon renewable energy and using an electrolyzer which takes water and turns it into hydrogen and a few other things as well, I think we need to be very careful about grey hydrogen, which is essentially made from natural gas, and you treat that and you can make hydrogen out of it. So yeah, I would make I think there are some great applications for hydrogen. I think us getting green hydrogen into our gas grids is over a decade away. I think hydrogen can be used in transport, particularly in enclosed areas, things like forklift trucks, but there is a potential to use it in marine setting for transport as well as in trains, but we've got to make sure that we're not emitting huge amounts of CO2 to make that hydrogen first, because it kind of nullifies the point there. A quick answer to a fascinating question. I'll stop there.
Another one here. This might be slightly more tricky, Mike, and somebody's asking us about the potential similarities between the fossil fuel companies in the past and big pharma at present, i.e., the fossil fuel companies have participated in leading us into some of the problems we're facing globally now. And is it possible that big pharma might lead us to new problems in the future?
Well, I think there are different bits of pharma, we see some really interesting stuff that's going on, innovation in healthcare, and we think that particularly understanding genetics better, and this idea that you might be able to have much more targeted treatments that's specific to a person's individual needs is a really interesting area. I think there are some areas and some drugs that pharmaceutical companies have used that maybe aren't that great, but I think that the vast majority of these disease treatments are beneficial. They wouldn't get through the trials if they won't. And I've seen a really interesting thing with this COVID-19. Normally vaccines take a decade to develop. And I remember when this first hit, we were talking as a team, and we were really hoping our best case scenario really was that we were going to get a vaccine that worked and that was safe within a sort of 18-month period. And the fact that that's happening now, pretty much 12 months since, highlights that there are some really positive things that come out of that. Again, there are lots of different ways to play improving healthcare. It's not just about big pharma making drugs, but innovations that help us make these more effective. And don't forget, a lot of the disease burden that we've got today is exacerbated by bad lifestyles. And if we can do anything to encourage exercise and improve the quality of food that people have, that's going to have a massive positive impact on health as well.
Rather specific one here, Mike. Would we invest in Tesla?
Mm-hmm. Well, we have invested in Tesla.
Not? And do you think it's overpriced? You don't necessarily have the second part.
Okay. Yeah, so we've followed Tesla for quite a while. Maybe 3 or 4 years ago, we were invested in Tesla, but we exited out of Tesla because we had there are very positive environmental aspects to the electric vehicle, etc. But we were not happy with the governance. Elon Musk is a bit of a live wire, love him or hate him, and I think after some very rude tweets to the regulator, we decided that coupled with the fact that this is probably about 3 years ago now, there are a lot of noises coming out beginning to come out that it was actually a very horrible place to work at Tesla, and there were no real whistleblowing ways to make a complaint, and also the safety stats in Tesla, because they were trying to meet these very, very tight targets. This is going back a few years now. That caused us to reappraise our view of Tesla, and we are not invested in Tesla now. We have been in the distant past, but we haven't been invested in them for a while. It's an interesting company, though. Are they overvalued? I haven't had a look. I have to say, their announcement of investing 10% of their cash, something like 1.5 billion in Bitcoin, wasn't. I don't view that as positive at all.
Yeah. Yes, that's another story which we can discuss. We have another couple of questions which I can just very quickly answer. Do we have a euro share class of the Global Growth Fund? Yes, we do. Somebody's asking the very broad question that can you convincingly achieve high returns while you also adhere to sustainable investing? And again, perhaps I will venture to answer that, but Mike, you might want to say something.
In a word, yes. Our track record shows that. There's a lot of stuff. This was an introduction to sustainable investing. I purposely have resisted from saying this is how we do it and this is our engagement and this is what we've achieved. But no, there are a number of funds that have demonstrated very competitive risk-adjusted returns versus their conventional peers that are super sustainable and answer that question exactly. So yes, it is possible to do the same.
Yeah, okay. We have a question about just fund managers in general that are claiming to be sustainable, and how can you actually tell if this is true and not just a marketing approach, or what we call greenwashing. I'm just going to chip in with a first part of that answer. The funds that we offer in Malta, the Sustainable Future Funds, will have the SFDR Article 9 rating. Now that sounds like a lot of acronym and Chinese, but what that basically means is they will have the highest level of sustainability rating that the European Union is imposing on all fund managers in order to classify their funds, as from the 10th of March. And you might just want to add a little bit more about that, Mike.
Yeah, I think the most important thing is transparency and disclosure. You should be able to see very clearly what a fund won't invest in, what it will invest in, what it is invested in. You should be able to see every company they're invested in. You should be able to challenge them if there's any company in there you're not happy with, and get a really good reason for why that is in the fund. And that's something that a lot of advisors find very helpful that we do. The other thing is, it's like any other fund. What's the track record like? How long have the team been together? What do the risk-adjusted returns look like? This is no different from another fund, but you really want to see a team that's been doing sustainable investment for a while. I'd be very skeptical of anyone that mentions the term sustainability is in our corporate DNA, because it doesn't mean anything. It's complete nonsense. Lots of people saying it. Slap them, stop them from doing it. It doesn't mean anything. There are some red flags where people, sustainability is not an excuse to talk rubbish. It's a proper investment style. It's proven, and it's something that is quite rightly gaining attention, and something that people want more of.
Great. We've got one more question. So if you're all listening, then please feel free to send through more, because we're here for the evening if you need us. That is really relating back to, you touched upon the COVID crisis. It's perhaps quite easy to say that not owning oil, etc., was good last year, and hence we can show good returns for 2020, which may inflate returns looking backwards on a cumulative basis. So what is our ability to continue generating these returns?
That's a very good point. I mean, I suppose there are a couple of observation I'd like to make. These funds were performing very strongly compared to their conventional peers before we went into the crisis. So it's certainly not the case that this is an anomaly. And I think going forward, yes, it obviously not owning a lot of the commodity sensitive side of the market and some of the areas that led the market down has been positive. But the COVID-19 effect has had a different impact on different themes. Some of them have accelerated. You can think of the whole working from home thing. Anything to do with cybersecurity and communication and connecting people has obviously gone through the roof. A lot's happening in medicine as well. And there are some other areas where the brake has been put on it. So, for example, if you are an operator of an affordable gym, in many parts of the world, none of your customers are allowed to come there. So it's affected different things in different ways. But I think if you think forward 10 or 20 years, a lot of the challenges that we're facing today, they're not, they're going to be the same. We're still going to be concerned about essentially the impacts we're having on our environment and how unequal our society is, and trying to level up both of those sides of the equation. And therefore, I think a lot of the investment trends that we're looking at will be very relevant over the decades to come. And I still think that they are really interesting areas to find structural growth in a world that's going to find its growth rates trending down over time, as we've seen sort of since the 60s.
Great. Thank you, Mike. I'm going to hand now back to Ingrid at MeDirect. And just on behalf of Mike and myself, we'd really like to thank you for joining us this evening. But please just stay around for the closing remarks from Ingrid. Over to you, Ingrid.
Thank you for your time and for all the information provided. I am sure we all found it very, very interesting. Possibly in the future we can organize a further MeDirect talk on sustainable investments to also take this a bit further. A big thank you also goes to all of you who joined us today. May I remind you that our team of advisors are available if you have any further questions on sustainable investments and investments in general. Further information on the funds discussed today can be also found on our website. And once you log on to our internet banking, you would be able to find even more information. Thank you once again for joining us, and stay safe, everyone.